Let's talk about individual retirement accounts, often called IRAs, and a few other individual retirement accounts available to self-employed people. These are a great way to save for your retirement. I'm sure you know about Social Security. I'm sure you've heard people say, oh, Social Security is not going to be there when you retire, et cetera, et cetera. I don't know if that's true or not. You know, it's a government program, so who knows? The government prints all the money they want, so I think your benefits will probably be there if our country's still around by the time you retire. Um, so there's some other things you can do for your own retirement, and I highly, highly encourage you to do these and start now. The younger you are when you start, the more time you have to increase your retirement account. And if you remember from like principles of accounting, the time value of money, you know, a dollar invested today has a future value, a much higher future value the more time you have. So if you're in your 20s right now, like I am, you know, putting $1,000 in a retirement account today, by the time you're 67 or 68, that $1,000 is going to have grown significantly. And this is one of the things I think we talked about earlier. I was going to show you how you could make your children millionaires when they retire just by doing a simple IRA plan for them. So let's start taking a look at some of these IRAs, and then I'll show you how you can make your child a millionaire. Okay, so we're going to compare the main two types of IRAs. The traditional IRA has been around for a long time. It was around when I was a kid, which was just 3, 4, 5 years ago. But here, let's look at the properties of a traditional IRA. Your contributions are a deduction for AGI. So you put money into your account and you get to deduct it for AGI. Distributions are taxable. So when you take that money out, when you retire, you're now going to pay tax on it. So what you're doing here is you're getting a deduction today to pay taxes later. So the theory behind this is right now you're earning a lot of money. Hopefully you're making over $100,000 a year and you're in that 35% tax bracket. So if you put $1,000 into an account, you're going to save $350 on your taxes because you'll get a tax deduction for $1,000, which would lower your taxable income by $1,000 and therefore save you $350. And then when you retire, you're probably not going to be making over $100,000 a year, and you're going to drop down into, maybe that 10 or 12% tax bracket. And so now you can pull that $1,000 out and only have to pay, maybe $120 of tax on it. So you would have saved money now, and you'll save money in the future when you have to take it out. So there are a couple of rules about them. Distributions before you turn 59 and a half, and I have no idea why the IRS chooses 59 and a half. Why didn't they just say 60 years old? I don't know. The IRS loves to put little weird stuff like this in here just to make our lives difficult. But when you turn 59 and a half, you can take it out without any penalty. But when you're under 59 and a half, you will incur a 10% penalty. And you might think this is a good thing to keep people from touching their IRA accounts, but I see it all the time. Every year, I get a handful of people who needed a new car, wanted to put a down payment on a house, wanted to go on a vacation, and they see their IRA account sitting there flush with cash, and they just like, yeah, let's just take 10 grand out of that thing. Well, taking $10,000 out is going to cost you $1,000 in penalty, and you're going to have to pay tax on it. And since you're making 100 grand a year, you're in the 35% tax bracket, you're going to pay 35% tax on the 10 grand you take out plus this 10%. So you're paying 45% to take out this early distribution. So I try to encourage my clients, don't touch your IRA, leave it alone, forget about it. Put it on an automatic contribution where money comes out of your, say, bank account or whatever automatically every month. That's what I do. And just forget about it. Earnings and growth in the IRA are not taxable as they're growing. You only pay tax on your distributions. So it doesn't matter how much your account grows. If you put $1,000 in now and 60 years from now it's worth $500,000, you're going to pay tax on that $500,000 when you draw it out. You're not going to pay any taxes in between now and then. You only pay tax on the money you actually take out of your account. And the last rule we're going to look at is what we call RMDs, required minimum distribution. When you turn 70 and a half, again, why didn't they just make it 71? I don't know. Talk to the IRS. When you turn 70 and a half, you have to start taking money out of your account. The IRS doesn't want you to die without giving them their fair share of taxes. Remember, whatever way gives the IRS more money, that's what they want. So making you take the money out is going to make you pay tax on it because distributions are taxable. And so they give you till 70 and a half to start doing it on your own. If you don't, then you're going to have to take the money out. And what they do is they divide your lifespan up. They have a table, they're called life or death tables. I can't remember what they're called, but they have a table where you look in your age and it'll say, okay, a 70-year-old person has a life expectancy of 18 more years. So you would take your balance of your IRA, and let's make the math easy and say the balance is $18,000 and your life expectancy is 18 years. You divide the balance by the years they expect you to live, and you'd come up with your RMD amount. In this case, it would be $1,000. So you would have to take out $1,000 from your IRA this year. And if you don't, there are some penalties because, you know, the IRS loves their penalties. And then the other one is relatively new. It's been around, I shouldn't say relatively new. It came out while I've been a CPA. So, you know, since the 97s, early 97s or whatever, the Roth IRA coming into play. Some big differences. There's no deductions for your contribution, which is a 180-degree turn from here where contributions are a deduction. This one, you pay for it after tax money. So you just pay for it out of your taxes, out of your pocket. But here's another 180-degree. Distributions aren't taxable. This is an amazing one. Distributions are not taxable. Over here, distributions are taxable. So you can see this is kind of like the complete opposite of a traditional IRA. Here you have deductible contributions. Here you have non-deductible contributions. Here you have taxable distributions. Here you have non-taxable distributions. But to qualify for these non-taxable distributions, you have a couple of rules. You have to have left it in there for 5 years, and you have to be at least 59 and a half. Distributions before 59 and a half, just like our traditional IRA, are going to be taxable and have a 10% penalty. The one exception to this are your contributions. The money you've put in there can be withdrawn tax-free because remember, you didn't get a deduction for it. So you put it in there with after-tax money. So they allow you to take it out tax-free because again, it was money that was already in your pocket. So you can put it back in your pocket without a penalty. Earnings and growth in the Roth are not taxable when you take it out according to the rules here. And there's no RMDs. The main reason for this is because, again, you're not getting a deduction for your contribution. So the IRS has already got their taxes, so they're kind of happy with it. And they're not going to get any more taxes out of you because distributions are not taxable. So there's no RMDs. They don't care if you leave it in there from now on or whatever. So this is a great one. And I tell people, if you're going to not retire for at least 5 years, do the Roth IRA. This is a much better way to grow because the stock market has a historical increase of 10% per year. And so if you can leave your money in there for at least 5 years, you're going to grow your contributions by 50% in theory. Hopefully that'll work. And so you're going to have much more money than what you put in there, and you're going to get to take it all out tax-free. So I highly encourage you to use a Roth IRA if you can leave it alone for 5 years. And if you're young, if you're in your 20s or 30s, the Roth IRA is without a doubt the way to go because your money will have a long time to grow in there. So if you've got, 30 or 40 years until you retire, if the stock market has a historical average of 10%, your contributions are going to be way more than double or tripled what you originally put in there. And so again, because the distributions are not taxable, the Roth IRA is the way to go. And so when clients come in and say, hey, I made $5,000 contribution to my Roth IRA, what do I do with it on my taxes? I say nothing because there's no deduction for your contributions. All right, so here's where we're going to show you how you can make your child a millionaire by the time they retire. And so what I generally tell self-employed people to do, it's a lot harder if you're just an employee somewhere, but if you can get your kid to earn some money, $5,000 a year, and then put that $5,000 into their retirement plan, we can look and see what we have here for growth. So here's what I've done. So I often tell people to do this when their kid turns 13 and have them work for you for 5 years. That would be till they're 18, and pay them $5,000 a year for each year. And don't give them the money, put it into a retirement account. Put it into a Roth IRA, because we want them to be a millionaire, and we also don't want them to have to pay taxes on their money. So here I'm assuming a 5% growth rate. So the first year when they're 13, you put $5,000 in their account, they earn 250 bucks. So now they have a balance of $5,250. Next year, $5,000, they've now got $10,250 in there, and they earn $513. Here's their balance. You keep doing that for 5 years. Here's the last year. They turn 18 this year. You put $5,000 in it. But look at it. By the time they're 18, they have nearly $30,000 in their account. So let's fast forward 48 years when they retire. So this would be approximately 68 years old, which is the retirement age for people that are going to be retiring 40 years from now for Social Security purposes. You've only put $25,000 into their account, and they've now earned $211 in earnings over the last 48 years, and now they have $236,000 that they're going to be able to draw out tax-free. And so this is a great way to really set them off on the retirement. But remember, I said I want to make them a millionaire. Well, if you look at the historical average of the stock market, it averages 10% per year. I'm not saying it goes up every year 10%. Some years it might be down. Some years it might go up 1%. But when you average it from the day one through today, the average is 10% per year. So some years you're going to be down 10%, but some years you'll be up 20%. And so the average is 10%. And so we're going to do the same thing. When they turn 13, we hire them to work for us and we pay them $5,000. We don't give them a penny of it. We put it into their Roth IRA, but now they've earned 10%, so they've earned 500 bucks. We do that every year until they turn 18. By the time they turn 18, they've earned $33,000. 48 years later, when they're now 68, we've put $25,000 into their account, and now look what they got. They have earned $1.9 million and have $2 million sitting in their Roth IRA account that they're going to be able to draw out tax-free. This is the value of compounding interest, because they're going to keep growing money on their principal contributions right here, this $25,000, but then they also earn money on their earnings. And look how much earnings they have. We've put $25,000 in, but we are going to earn nearly $2 million of earnings. And so this is the power of it. So here's the ages we were talking about. If you can't do it when they're 13, start it when they're 18. It'll work just as well. In fact, this is what all this is calculated on. If you can get a job and earn $5,000 per year when you're 18, you can make yourself a millionaire by the time you turn 65 if you'll just follow these principles. You just need $25,000 that you can leave alone for 48 years, and you'll be a millionaire. And the reason we say earnings, they have to have a job, is because both of these IRAs, you have to have earned income to be able to contribute to it. You can't just put $5,000 into a baby's a Roth IRA because it's not earned income. They have to have earned income in order for you to be able to make a contribution. So that means they have to have a job. Of course, when you're self-employed, you can easily hire them to work for you, to sweep, to take out the trash or whatnot. So it's really easy to get them earned income when you're self-employed. So there you go. Now you can make your children a millionaire by the time they're 65. And remember, these guys will be picking your nursing home. So I think you want your children to be millionaires by the time you're old and gray. You want them to pick a good nursing home for you. So make them a millionaire and they'll probably take care of you. All right, so let's look at the contributions. Both the traditional and the Roth IRA have contribution limits. The limit is the lesser of $5,500 or $6,000 for 2019. These go up, minorly every year, or earned income. So this is why we're talking about they have to have a job. The kids I'm talking about, they have to have a job because you have a limit, which is the lesser of $6,000 or earned income. If their earned income is zero, the most you can contribute to an IRA is zero. If you're over 50, you can add an extra $1,000 to your contribution limit. So for 2019, you can contribute $7,000 if you're 50. Both the taxpayer and the spouse can make a contribution. These are IRAs, individual accounts. So there's not a joint IRA account. Each one of you would have your own IRA account. And so each one of you can make a contribution. If you're 50, you can make $7,000. If your wife or spouse is 48, they can only make a $6,000 contribution into their own personal one. The earned income, I didn't talk about this, the spousal IRA. If only one of you works, then your spouse is entitled to make a contribution based on your earned income. So if your spouse stays home and takes care of the children, they can still have an IRA based on your earned income. A person can contribute to a traditional and a Roth. I don't know why you would want to, but the total contribution cannot exceed the traditional limits, the 6,000 and the extra 1,000 if over 50. So you could put 3,000 into a traditional, 3,000 into a Roth, but again, I wouldn't do it. If you're young enough, put it all into a Roth. If you're older and you need the deductions now, yeah, go ahead and do a traditional, but I don't really see any reason to do a split like this. So a traditional IRA deduction limit, you can always make a contribution, but it may not be deductible. And I point this out because there is some income limitations on a Roth IRA. But with a traditional IRA, anybody can make a contribution, but you may not be able to deduct it. Non-deductible contributions add to your basis, and those are not taxable when they're withdrawn. So if you make a non-deductible contribution to your traditional IRA, when you withdraw it, you'll be able to withdraw it tax-free because you've already paid taxes on it. But tracking your basis is hard. It's not really hard, it's just paperwork. And you might be having to track this basis for 40 years. Are you really going to remember when you're 65 that you made a $5,000 non-deductible contribution when you were 25? Maybe not. So I really, if you're going to make a non-deductible contribution, I would just say put it in a Roth. Your deductible contributions start to phase out if you're covered by a retirement plan. So here the IRS is saying, well, if you have a retirement plan at work, you don't need the best of both worlds. You don't need to have a pre-tax 401k and a pre-tax traditional IRA. So they make you phase it out. So here's the phase out limitations. If you're single and you're covered by a 401k at work, your phase out is in between 63. It starts at 63 and ends at 73,000 at 100% phase out. Married, filing jointly, and you're a participant in your plan, you have this kind of phase out range. And then if you're a non-participant in the plan, you have this amount of phase out. So that's where your contributions would be non-deductible. So if you're making $200,000 a year, you cannot make a deductible contribution. You can make a non-deductible contribution and track your basis and then withdraw it later on tax-free. But again, like I mentioned, that's a hard thing to keep up with, and the IRS darn sure doesn't keep up with it. You have to keep up with it. There's no limit if you're single and not a participant, or married filing jointly and both are not participants. So let's look at an example. Drunk Uncle Larry earned $3,500 all year long, and he wants to make a traditional IRA contribution. What is his max allowable contribution? Well, I think you already know we're going to be limited by his earned income, so all he can make a contribution for is $3,500. Christy's not covered by a retirement plan at work. She's single. What is the most she can earn during the year and still make a deductible contribution? Well, there is no earnings limit since she's not covered. The IRS wants you to save up for retirement, and since she's not able to get into a plan at work, she could be earning $1 bajillion and still make a traditional IRA contribution. Sarah is a doctor earning $500,000 a year. Her husband's a stay-at-home dad and cares for the children. He has no earned income. Both are in their 40s. How much can Sarah contribute to a traditional IRA? Well, as we just learned a while ago, she could contribute $5,500. She can make the contribution even though it's not going to be deductible. This is the 2018 limit. 2019, it would have been $6,000. How much of a deductible contribution can her husband make? Zero. They are way phased out. Even though he's a non-participant, their joint IEGI exceeds the threshold for making a deductible contribution. What is the total amount of non-deductible contributions? $11,000. So he can't make a deductible contribution, but he could absolutely use the spousal exemption and make a non-deductible contribution of $5,500 for 2018 or $6,000 for 2019 for himself. So Roth IRA conversions. What if you have a traditional IRA and now you've heard me tell you that you should really be in a Roth IRA, and you go to your broker and say, hey, can I make my traditional IRA a Roth IRA? The answer is absolutely, you sure can. Lots of people back then, when they came out in '97, a lot of people realized the value of it and they wanted to convert to Roth IRAs. So to help out, the IRS allows you to convert your traditional to a Roth IRA. You have to pay income tax on it, but not the penalty. Because remember, your traditional IRAs, you already got the tax break because you're allowed to deduct it up front, but the Roth IRA is an after-tax contribution. So you have to pay income tax on the balance in your traditional IRA and stick it into a Roth IRA, but you don't have the 10% penalty. So let's look at a big no-no, early distributions. Now I know sometimes things happen in life and you have to have the money now, but try hard to avoid taking money out of your IRAs early if you can avoid it. So all distributions from a traditional IRA are subject to income tax, either a regular distribution when you're over 59 and a half, or early distributions when you're not 59 and a half. So that's what we're talking about early. You're not 59 and a half and you're taking a distribution. So that would be an early distribution. So all distributions from a traditional IRA are subject to income tax. Early distributions before you're 59 and a half are subject to a 10% penalty in addition to the income tax up here. So if you're in the 15% tax bracket and you take an early distribution, you're going to pay 25% on that distribution. So that's another reason I say avoid it if you possibly can. But there are some exceptions to it. The IRS realizes you might have a hardship that requires you to take an early distribution, like you become disabled. If you're totally and permanently disabled, you can take early distributions and not pay the 10% penalty. So all these exceptions we're talking about are only for the penalty. You will always pay tax, income tax on distributions from a traditional IRA. I am not aware of any exceptions to this rule right here. What we're talking about is getting you out of the 10% penalty. The exceptions to the 10% penalty are these down here: being disabled. If you die, good news, if you die, you don't have to pay a 10% penalty. But this is really going for your beneficiary. You can leave your IRA in your will or whatever to whomever you want to, and they can withdraw the money penalty free. They will pay income tax. I think we've already talked about how inheritances are not subject to income tax. So if your grandma dies and leaves you $1 million, you're not going to pay a penalty of income tax on that inheritance. But if your grandma dies and leaves you a IRA that has $1 million in it, you are going to absolutely pay income tax when you take that money out. The IRS does allow you to either draw it out all at one time or a series of distributions, so you don't have to pay the tax all at one time. Medical expenses, there are some rules about this, only if it exceeds 7.5%, and this is the 2018, I believe it's 10% for 2020. If the medical expenses that exceed 7.5 or 10% of your adjusted gross income, then you can draw money out penalty free from your traditional IRA. This one's really hard to get to because if you're earning $100,000 a year and you draw out the AGI limitation on it would be 10%, so you would have to have medical expenses in excess of $10,000 to be able to get out of the penalty. So if you drew out $15,000 for medical expenses, you would only avoid the penalty on $5,000 that exceeded your 10% of AGI. If you're unemployed, you can draw out money from your IRA and pay your health insurance for it. You must be unemployed for 12 weeks. This one's been a hot topic with COVID going on. This one is very popular these days because people are getting laid off. Higher education, you can draw money out for your tuition fees, books, room, and board. Again, not a recommended thing to do. There's other ways, go get a student loan or Pell Grants or whatever. Don't use your retirement account to pay for your higher education if you can avoid it. This goes for, you, your spouse, your kids, grandkids. First-time home buyers. This is a weird one. I don't know why they did that. You can draw out $10,000 penalty-free, still paying income tax, to buy a first-time home, your first home. Of course, the first home just means you haven't owned a principal residence in the last 2 years. Again, not something I recommend, but hey, if your dream home is about to go away from you because you can't get a down payment, then, you got to do what you got to do. Due to the IRS levy. Again, what way gives the IRS the most money? Well, if we let him draw money out of his retirement account, he can pay us his taxes. All right, let's let him do that tax-free. So here you go. So it's nice of them not to penalize the money that you're about to give to them. Very nice. Qualified reservists, this happened after 9/11. It allowed, reservists who are getting called up for active duty and whatnot, they might need to take out some money to take care of some business before they go out on deployment. And as you know, those deployments were often extended and whatnot, and they were gone for a year or more. And so this allowed them to take money out tax-free to take care of some of their business. Let's look at Roth IRA distributions. Distributions are tax-free if withdrawn after 5 years in at least one of the following. You're 59 and a half or more. We got to keep that 59 and a half number in their mind. If I ever get elected president, I'm going to make the IRS round everything off to an even number. This just bugs my OCD to no end. You are the beneficiary and the distribution is due to the owner's death. So here, a while ago, we just talked about if grandma dies and leaves you a traditional IRA with $1 million on it, you are going to pay tax on that $1 million as you draw it out. But if grandma dies and leaves you a Roth IRA with $1 million in it, then you're going to get to draw that out tax-free. Again, if you become disabled, first-time home buyer, a lot of these are the same ones as what we were just looking at. Distributions before the 5-year limit can be penalty-free if you meet one of the following. Again, these sound very familiar, right? We just looked at some of these on the other page. The only one we didn't talk about is this Section 72T thing. Basically, what this is doing is taking the balance of your account and dividing it by your life expectancy, and you can take out that money in equal payments. I don't know why they allow them to do this. We don't really encounter this one very often. We encounter a lot of these other ones, and we encounter ones that aren't on here because people just need the money, so they take it out. So pretty much these are the same exemptions as a traditional IRA. And again, please note that this gets you out of the 10% penalty, not the income tax. You will have to pay income tax on the earnings. That's because you're not doing the 5-year thing. So you're going to have to pay income tax on the earnings. And remember, you can always withdraw your contributions tax-free at any time from a Roth IRA. It's the earnings and growth that are subject to penalties and maybe some income tax. So this really makes a Roth just heads and tails better than a traditional IRA, in my opinion. You should always consult with your financial advisor if you have one. If not, well, good luck. So self-employed people often have another plan. Now, if you notice, the contributions to IRAs are very small, $6,000, $7,000. Contributions to like 401ks are a lot higher. They're like $14,000 and $15,000. And so there's some ways for self-employed people to contribute to retirement plans that allows them to deduct it a lot higher, allows them to deduct higher amounts. Generally, they require that they're available to all employees and their separate accounts to hold the funds. There's early distribution penalties, et cetera, and you got to have a vesting. So these are requirements to be able to have one of these programs. But they allow you to go up to 25% of earnings or $55,000. So you could, in theory, put 55 grand into a retirement account that for yourself, for small businesses and self-employed people, and that would be really helpful. I mean, we looked at how just putting $25,000 into account and leaving it alone for 45 years would get you to be a 2 millionaire. Imagine if you could put $55,000 in it in your 20s and leave it alone until you're 60. It'd really be amazing what you could do with that. Okay, so now that you know how to make your children millionaires by the time they're 65, just for the record, my mom did not know this when she had me, so I don't think I'm going to be a millionaire by the time I'm 65. So maybe you guys can get a jump on that and live large in your retirement years, and maybe come by my drive-thru and let me give you a burger and fries so during my retirement years. All right. Coming up next, we're going to look at some of the miscellaneous deductions for AGI. These are just small little ones that the IRS gives us, and we'll take a look at those in the next video.